This is LONGWave, featuring technical analysis and market analytics by Gordon T. Long, editor and publisher of GordonTLong.com. The content of this presentation is strictly the opinion of Gordon T. Long and is based on his analysis, which he feels to be accurate and unbiased. Participants may or may not hold positions in any securities that are discussed. You should always consult a registered investment advisor before making any investment decisions. Now, let's join Gordon for today's show.
Good morning. It's Friday, February the 7th, 2014. I'm Gord Long at GordonTLong.com. A reminder before we begin, do not trade from any of these slides this morning. They are commentary for educational and discussion purposes only. Always consult a professional financial advisor before making any investment decisions. The purpose of the audio slides is to talk about the areas that are not updated in your monthly analytics and technical analysis report. This is based on our annual cycle as outlined on the subscriptions page on our site. We intentionally keep the technical analysis charts to the subscribers report so as not to confuse them with the drivers operating behind them. But this month, however, we're going to diverge slightly from that, and I'll explain that in a moment. Drivers in the long term are primarily the fundamentals, in the intermediate term risk, and in the short term confidence and sentiment. In this regard, I like to distill this month's audio down to a discussion on the January sell-off we are presently in the throes of, the lead up to it, and where we expect to go from here. Abruptly, from a world that seemed quite calm economically, we suddenly appear to have issues popping up all over the place. In reality, the issues now getting the press are not new, but rather the media and public's view of them has changed. Sentiment has temporarily changed, as it always does, in a cyclical and somewhat predictive manner. This is why we put such an emphasis on consumer, investor, and trader sentiment and confidence in our various reports. I'd like to break this discussion up into three parts, but unfortunately, because of the extensive amount of it, I'm only going to be able to cover part one in the video here this morning, and that is what we predicted, what happened, and what it means for the financial markets in 2014. The November pre-budget weakness, the Santa Claus rally, our January 14th and late January turmoil call, and the M's of 2014. Therefore, the part two, I wanted to talk about the 7 unfolding macro highlights you need to focus on. I have put into the study section in your report this month in detail. But just as a highlight, what we got and the charts extensively show is China is slowing, and with it the global economy is slowing, and I would suggest even accelerating in a slowdown. Investors are losing confidence in economics, and that has a significant impact to the carry trade. Emerging markets are feeling the most pain, as obvious in the press, and something I was writing extensively about in the fall and summer in my papers on the echo boom, and that the problems would start in the peripheral and work to the core. There is a new worry, however, of the EU bank exposures to the emerging markets, which is really rattling. Markets not getting a lot of press, but it's there, $3 trillion to be precise. And the U.S. economic data and recovery has been just mediocre at best. If you get real data, it's been terrible, but on the published data, it's so-so. And there's an emerging pressure on the Bank of England to tighten and the ramifications with it. And again, I have this laid out in the study section of this month's report, and you can go through that to confirm at least where the conclusions that I'm drawing on it. What we have is we have a global economy that's becoming flushed with cash, but with a dearth of demand. Why? Shrinking real disposable incomes. And this chart I have here of China is really telling, and it shows that when we had the explosion of credit, it really ran out of steam with its ability to be applied and subsequently fall down in 2008. And of course, credit has been exploded in China through its shadow banking system, and it's looming up, and we're approaching the same kind of inflection point we had in 2008. We're not there yet. Despite what's going on in the markets, I do not believe we're there, and I'll show you why. The third part I want to talk about also the charts that had to be moved into the study section this month is what I refer to as a taper tantrum in 7 charts. The equity context that it's built within, the widespread impact, and specifically countries that are telltale. Argentina, Turkey, Chile, Russia, South Africa, the BRICS, the peripherals. This is where the problems are stemming from, and they will continue to get worse at an accelerating fashion. However, there is a short-term respite that's coming here. What I'd like to do now is to take you through a little bit of history before we get into where we're going. We had a textbook log periodic cycle which ended right on schedule. The market rise from the 2008 lows followed a very ordered pattern, which is best modeled using the mathematician Dr. Dieter Sornett's log periodic cycle. I followed his work for years when he was originally at Berkeley, but now his work is becoming a little bit more mainstream. We adopted it at Gordon T. Long with the announcement specifically of QE3 because it best fit the technical oscillation patterns we were witnessing at that point in time, and our belief that liquidity was driving asset prices and credit, which is camouflaging deteriorating economic conditions, would continue to do so until collateral values imploded due to mispricing, malinvestment associated with the inability to achieve realistic price discovery. And I believe that's exactly what is still in the process of unfolding. In November 2013, last fall, we published an article called Cascading Separation Signals, where we outlined that the non-equity markets were breaking down in an orderly fashion and were early signals of market turmoil that was ahead, but not there yet. In November, as the budget wrangling and government shutdown discussions awaited the December Super Committee's recommendations, it was clear that after a brief consolidation, there would be a strong Santa Claus rally. We felt the rally would continue until late January and not begin correcting any sooner than January 14th. But we published a series of articles under the banner of Melt-Up Monitor, laying this out and including how there would be a strong Santa Claus rally following the December FOMC meeting, irrelevant of what the Federal Reserve would signal at that point in time, specifically and exactly what happened. This chart is taken from our November 25th report and showing how it fits into this log periodic pattern and where the Santa Claus rally fit into the log periodic pattern. On December 24th, Christmas Eve, we released an analytic insights entitled Market Turmoil Beginning After January 14th. And this went out to all our mailing notification subscribers. As the Santa Claus rally was taking hold, it was clear that the terminal point was after January 14th. The market high was in fact and is currently January the 15th. This chart and the following one here were taken from that notification mailing. And what was becoming clear to us was how this would unfold based on the work we were doing in our globalization thesis for 2014, and that we would see what we refer to as double M's, a small M top and then a larger M top. Now, M's don't necessarily come out in an exact pattern of matching double highs. Sometimes the external strength, which is the right-hand side of the M, can be higher or slightly lower. Time will dictate just how much. Though there's some evidence that we may have multiple fractals laying out, and you're looking at the large pattern here back to 2000 and the multiple legs, and in fact this last set of M's may unfold in a very close fractal of that particular pattern. But what we do believe is you're going to see two M's unfold. If you expand the schematic below, you will see the stages and why we expect it to be in this fashion, because it gets back to our macro analytics and our macroeconomic analysis that we do. And it's about going forward, about deflation and hyperinflation, getting both and in which sequence. They are still ahead and labeled by the large M top consisting of the real deflation leg labeled DR and the hyperinflation leg labeled H1. The long wave up all the way from the low in 2008 is all really one inflation leg, with hyperinflation being the last terminal part of the leg. We're not there. As I said, we're still entering down in this DR where real deflation enters into the discussion. The long-term sloping lines, regression lines, is a long-term regression channel line going back to August 1971 when we came off the gold standard. And there's a lot of reasons why we use that particular regression, mapped with regressions from the 2000 technical high, because of the distortion to currencies. And it's been very, very accurate in predicting the kinds of points where we get inflections. And you can see these M's are matching very closely with that currently. Drilling down to another level and breaking it out, we have some where we think will be some potential support and resistance level. The point I would make on this, the bottom of the real deflation leg, we believe will be anchored and held where collateral values will be guaranteed by government and agencies. We believe there's going to be a collateral crisis that starts to loom because it's so prevalent. If equities fall or bond prices fall, the over-leverage of debt through rehypothecation and the repo market will just implode in the market. So the collateral values will have to be guaranteed. That gets into Sally Mae in the student loans ends of it. It's going to get into the real estate investment trust assets through CLOs because of the whole shadow banking structure now using something called structured financial vehicles. It's a mirror image of 2008, just different names, different acronyms. And this is all laid out in detail in this year's thesis paper under the financial crisis section within it, describing this whole shadow banking phenomena that we're looking at right now. And for those that aren't subscribers, if you sign up to any of our trial subscription offers, you'll get access to the full paper right now. This slide we published on January the 28th, and don't be concerned yet. It's showing two lines that are coming up, a blue and a red, and that's the 50-day and the 100-day moving average. And we predicted that we would be falling down through that little yellow line. In fact, that's where we're on our way to have been through and on our way through right now. I'll show in a second. But that we would then rally from that point as we go back up towards that red bar, which is a gap that has not been filled yet. That's the left and the beginnings of the right side of the small m that I referred to earlier. And so there will be a fairly violent rally back up that will probably take us towards quadruple witch in late March as we kind of climb a wall of worry, but basically putting in a short-term intermediate top before we start to fall off into that wave I mentioned earlier of real deflation. There's a whole concept of banding here. These 50-day and 100-day moving averages and the 200-day moving average don't suddenly just start falling straight off. They actually work together, band themselves tightly, and then start to cross into various things called death cross. That takes time. That's what's going to unfold here. And the markets are pretty ordered technically because of the algo, the amount of algo pattern trading, of how they really make that banding unfold. I say that because I've been watching it for 10 years, and it's almost getting to be almost totally consistent. We track this, for those that are Trigger subscribers, extensively with our high probability trading zones and various technical analysis. This chart looks very complex. There's a lot of work that goes in the technical side of it at Triggers. But this is the S&P from a daily standpoint, and the red circles are the high probability or red ellipses, the high probability trading zones, and you can see we've been hitting them pretty well smack on, and which gives us a pretty clear roadmap of how things are unfolding from a time, price, and pattern standpoint. This is a 60-minute chart as we drill right down, which will then find support on a very long-term dotted line labeled a V5 using an Elliott wave count. This is a chart stepping back with a much longer term, at least back to 2009, showing the small m, where we'll get this rally up in black as we find the bottom, and you can see this dotted line suggesting where we think the support is. Whether we get a double top, slightly higher top, slightly a little shorter, time will tell, but it's somewhere in there, and then we start down in this real deflation leg. And you can see the kind of support where we think it'll be a scary bit of a sell-off, but it's not it's not as dramatic as it needs to be, and when you can historically for the types of sell-offs that we've had in the past. But it'll be enough to draw government action. It'll be enough to push off TAPER, or at least come out with a replacement for TAPER, a different name, because as the work with Richard Duncan is showing, there's about a $500 to $1 trillion shortage in liquidity that is currently there in all the flows that we put together, and they're just going to have to fill that by second half. It's all right through the first half, but after that there's a serious problem. This is another look at that same chart, a little different from our technical work, and showing the various support levels, but I'm also showing the 200-day moving average in here, and the 50 and the 100 as we will go through that banding, and the down legs and where the support is. You know, at the peak on January the 15th, the S&P was 12% above the 52-week. I'm showing daily moving averages here, but on a weekly basis, it was 12% above the 55-week moving average, which is itself above 20% above the 200-week. You know, at the peak in 2007, the S&P was 8.5% above the 55-week average, which itself was 14.5% above the 200. And at the peak in 2000, the S&P was 14% above the 55 and about 30% above the 200-week average. So it's high, it's elevated, it seriously should correct, but doesn't necessarily mean that we're going to start correcting a massive amount of this leg. It is going to be corrected, but not yet. I believe it's not into 2015 that we'll really see the big correction coming. This is a weekly chart from a triggers, and it shows in the two insert boxes, the one on the right, the M formations I'm talking about, and our prediction right now and all of the longer term charts says it should end in the last wave, which is that hyperinflation wave, should end Christmas, January, February of this year, next year, into 2015. These tie into some long-term elliptical Fibonacci circles that you can see drawn in the insert in the top left, and they all tie together, and they're all sending a very, very clear point from, as I said, from multiple analysis, and it's labeled here in the bigger chart, number 2, right up here in the top with the long-term purple trend line intersecting the concentric circles. So we're getting multiple stories leading us to the same kind of conclusion at this point. And as we said, you know, these things, we've always said they change regularly, or can change regularly, but often the bigger picture stays very much intact. The dates and some of the other things move around as various shocks come into the system and they're dampened out. We need to remember, too, that this is a mid-year election, and there's very clear patterns that we see in mid-year elections because of the change in Congress. And if we map that out, this chart shows the historical pattern with it. And by the way, that lays perfectly onto the charts that I've been showing here earlier with the M waves. And we didn't draw them because of this. We found that they're supporting some of the conclusions and we're coming out with technically at this point in time. This shows another look at it from mid-year term election patterns, telling us the same kind of story. Separately, one of the things that we really look at is trying to relate the bond market and the stock market, and there's a fairly consistent pattern, as you would expect, when the rotation from stocks to bonds and when yields start to fall on the treasuries is signaling that, you know, prices are going up, that there's a problem in the bond market, which says there's a problem in the economics, and therefore stocks usually follow from a fundamental standpoint. And you can see that in the green and the red lines here, noting that the yields are plotted in a reverse order on the right-hand side, or rather are inverted on the right-hand side. What it suggests to us is what we've been saying all along. We've really had a flat period of yield for a protracted period of time back to 2009 because of the distortions created by the Federal Reserve. And so we really haven't had that movement in yields, and we've been writing here for about a year and a half under financial repression, or since our financial repression, that we believe the 10-year yield will actually eventually fall to 1% and lower. I know that we're totally out of consensus on that, but we still believe that that's the case, forced by the government, under panic, under duress, and that's the green arrow, or the green line on the far right-hand side. And we see that happening sometime later into this year, where the yields will really start to accelerate down as prices in bonds go up, and it's a flight from safety, a flight to safety. It's going to come from the peripherals, the problem in the peripherals flowing into some perceived safety of the U.S. Treasury. As bad as the U.S. dollar is, bad as the U.S. Treasury is, it's the least ugly at the beauty pageant. Conversely, it's at that point that we start to fall off. We finish to some level of hyperinflation, and we will start to see currency really take the effect, and markets plummet in both real and nominal values. Last chart, and this is another way of looking at it, is the probabilities of the S&P 500 index being in a bear market. This is a work that's, according to Robert Lamy, in an article he put out, is a bear market hanging over our heads, and I'm going to quote him. Given the recent performance of the stock market, there is increased uncertainty among individual investors and stock market brokers about the prolongation of the actual bull market into its 6th year. Many of them are asking themselves if the declines over the past 13 business days is a signal of a near-term end of the 5th longest bull market since World War II and the beginnings of a new long-term bear market. A very plausible answer is no. The stock market cycle model predicts that the current bull market will extend through March. Exactly what we're seeing in our technical analysis, but he comes through it with some very sophisticated analysis and probability work. And he may be off, he may be wrong, but if you look at the magnitude, he'd have to be off by, well, completely reinventing his model. So it says there's a good chance that he's within the ballpark and others, and it just correlates that this says it's not time yet. For some of the reasons we've talked about before. I'm out of time, so we'll break. I encourage you to really study the study sections of this month's report with the sections I just mentioned and others in there. 2014 is going to be a very exciting year. There's going to be a lot of money made, and there's going to be a lot of money lost, so stay tuned. Talk to you later. Thank you for listening.
This has been Gordon T. Long, editor and publisher of GordonTLong.com. New recordings are posted regularly and can be found at GordonTLong.com. New show notifications are available through RSS feed, iTunes, and other social networking venues at GordonTLong.com.